Are you ready to supercharge your dividend income? Imagine earning over 19% annually on your investments, even in a volatile market today. We're diving deep into two powerhouse ETFs designed to maximize your dividend returns while providing stability in your portfolio. We'll compare their yields, payout ratios, and overall performance based on the latest data from July 2024. But that's not all. By the end of the video, you'll know which ETF is better suited for your investment goals. Whether you're looking for higher income, sustainability, and the growth, or a balanced approach, we've got you covered. Picture this, one of these ETFs offers a jaw-dropping yield of over 11%, but how do they achieve this remarkable feat? We'll uncover the unique strategy behind this impressive yield and reveal how it maintains a sustainable payout ratio, making it a top contender for your portfolio. The other ETF, not to be outdone, provides a robust yield of over 10%, leveraging a well-known index. We'll break down its payout ratio and dividend strategy, keeping you on the edge of your seat. Now imagine a $100,000 investment today in one of these ETFs. With the power of compounding, this investment could potentially grow to over $2.5 million in 30 years. Intrigued? We'll show you how this translates into substantial $307,001 annual dividend income, transforming your financial future in ways you've never imagined. We'll also dive into their total returns over the past year. One ETF has delivered an eye-popping return of 19%, while the other has posted a solid 11%. Understanding the risk and performance dynamics of each ETF is crucial, and will guide you through every detail. By the end of the video, you'll have a clear understanding of which ETF will best enhance your dividend income. Whether you're an experienced investor or just starting out, this comparison will provide valuable insights into helping you achieve your financial goals. Don't miss out, hit that subscribe button, and click the bell icon to stay updated within our latest updates and videos on dividend investing. Trust us, you won't want to miss this. JPMorgan Equity Premium Income ETF, JEPI. JPMorgan Equity Premium Income ETF stands out for its strategic approach to maximizing dividend returns while maintaining portfolio stability. Managed by JPMorgan Chase & Co., JEPI is designed to provide high monthly income through a combination of investing in large-cap U.S. stocks and selling call options. This blend of strategies ensures a robust income stream while mitigating some market volatility. As of July 2024, JEPI offers an annual dividend yield of 7.19%, which is quite competitive in the current market landscape. This yield is achieved through its option strategy, which generates additional income on the top of the dividends received from its equity holdings. The fund's expense ratio is 0.35%, making it an attractive option for investors seeking high income without incurring excessive costs. JEPI's portfolio includes significant holdings in well-established companies across various sectors. For example, it invests heavily in technology giants such as Microsoft and Apple, as well as in healthcare leaders like Johnson & Johnson. These companies are known for their strong balance sheets, consistent dividend payments, and growth potential, providing a stable foundation for JEPI's income strategy. The payout ratio for JEPI is approximately 80%, indicating that the fund distributes a significant portion of its earnings to shareholders. This payout ratio is sustainable, allowing the fund to retain enough earnings to reinvest and grow its asset base. Over the past year, JEPI has achieved total returns of 10.5%, reflecting its ability to generate income while also appreciating it in value. The compound annual growth rate of JEPI is another notable metric, standing at around 12% over the past 5 years. This impressive growth rate demonstrates JEPI's capacity for sustained performance, combining both capital appreciation and income generation. Investors in JEPI can benefit from the dual advantage of receiving high monthly dividends and enjoying potential capital gains. One of JEPI's key strengths is its risk management strategy. By selling call options, JEPI generates additional income, which can help cushion the portfolio during market downturns. This options strategy also provides a level of downside protection, as the premiums received from selling options can offset some losses in the underlying equity positions. This makes JEPI a sustainable choice for investors who are looking for some income but are also mindful of market volatility. JPMorgan Chase & Co. brings its extensive expertise and resources to the management of JEPI, ensuring that the fund is well positioned to navigate various market conditions. The firm's experience in equity and options market plays a crucial role in the fund's performance. The active management style of JEPI allows it to adapt to changing market environments, selecting the best opportunities for income generation and growth. In summary, JEPI offers a compelling proposition for income-focused investors with a yield of 7.19%, a low expense ratio of 0.35%, and a substantial payout ratio of 80%. JEPI combines high income with growth potential. The fund's strong performance with 10.5% total return over the past year and 12% CEGR over 5 years underscores its effectiveness in delivering consistent returns. Backed by the expertise of JPMorgan Chase & Co., JEPI is a robust option for those seeking to enhance their dividend income while maintaining a balanced approach to risk and growth. NEO's S&P 500 High Income ETF, SPYI. The NEO's S&P 500 High Income ETF is managed by NEO's investment and is tailored to deliver high monthly income with potential for equity appreciation. As of July of 2024, SPYI has an impressive annual dividend yield of 11.5% achieved through a strategic blend of investing in S&P 500 stocks and using a call spread approach with SPX index option futures contracts. The expense ratio for SPY is 0.68%, which, while higher than some other ETFs, is justified by its active management and complex income-generating strategies. SPYI's payout ratio is approximately 85%, meaning it distributes a significant portion of its earnings as dividends. This high payout ratio underscores its focus on income generation while still allowing for reinvestment and growth. Over the past year, SPYI has delivered a total return of 19%, outpacing many peers in the high-income ETF sector. This total return is a testament to its effective strategy and robust performance. The compound annual growth rate (CAGR) of SPYI over the past few years stands out at around 14%, highlighting its capacity for sustained performance. The CAGR reflects SPYI's ability to offer not only high income but also capital appreciation, making it a compelling choice for long-term investors. The portfolio includes major holdings in top-performing companies such as Apple Inc., ensuring stability and growth potential. The diversification across various sectors mitigates sector-specific risks and enhances the fund's resilience. The use of SPX index option futures contracts is a key component of SPYI's strategy. By selling these options, the fund generates additional income through premiums, which boosts the overall yield. This approach is also providing a layer of downside protection as the income from options can offset losses in the underlying equity positions, making SPY attractive to investors who seek income with a measure of risk management. NEO's investments leverages its experience in, options-based strategies to manage SPYI effectively. The firm's experience in this area is crucial for navigating market complexities and ensuring the fund meets its income and growth objectives. The active management style allows for dynamic portfolio adjustments to capitalize on market opportunities and protect against downturns. SPYI's strategic management is reflected in its strong performance metrics. The fund's robust portfolio and income-generating strategy have enabled it to deliver consistent returns. For example, the monthly distributions have been stable, with recent payouts such as $0.5088 per share in July of 2024. This consistency is crucial and critical for investors who rely on regular income for their investments. In summary, SPYI offers a compelling proposition for investors seeking high monthly income combined with potential equity growth. With an annual dividend yield of 11.5%, an expense ratio of 0.68%, and a payout ratio of 85%, SPY stands out in the high income ETF category. The fund's impressive performance with 19% total return over the past year and 14% CAGR over the past few years underscores its capability to deliver substantial and consistent returns. Backed by the strategic movement and management of NEO's investments, SPYI is a well-positioned one to continue providing significant income and growth potential, making it an attractive option for income-focused investors looking to enhance their portfolios and a robust and resilient investment vehicle. Long-term growth projections. Growth projections for JEPI, Year 1. Starting with $100,000 investment in JEPI, Harry can expect significant dividend income given the ETF's annual yield of 7.19%. In the first year, Harry would receive approximately $7,190 dividends. Assuming the fund's value remains stable, his investment would still be around $100,000 plus the dividend income. Year 5. Over 5 years, reinvesting the dividends can significantly enhance the investment's growth. With an annual yield of 7.19% compound annually, Harry's investment would grow to approximately $141,985. The annual dividend income by the end of the 5th year would be around $10,000, to be exact, $10,205, reflecting the increased investment value due to reinvestment. Year 10. Continuing with the reinvestment strategy, Harry's initial $100,000 investment in JEPI would grow substantially. After 10 years, his investment would be approximately $201,166. The annual dividends at this point would be around $14,466, further boosting his income from the fund. Year 20. With a long-term horizon, the power of compounding becomes even more evident. By the end of the 20 years, Harry's investment in JEPI would have grown to approximately $404,550. The annual dividend income would be now around $29,064, providing a substantial and significant passive income stream. Year 30. After 30 years, Harry's investment in JEPI, assuming the same annual yield and reinvestment of dividends, would be worth approximately $812,724. The annual dividend income at this point would be about $58,223. This projection shows how a consistent investment and reinvestment strategy can significantly grow an initial investment over a long period. Growth projections for SPYI. Year 1. Starting with a $100,000 investment in SPYI, Harry can expect an annual dividend yield of 11.5%. In the first year, this would provide him with approximately $11,500 in dividends. Assuming the fund's volume remains stable, his investment would still be around $100,000 plus the dividend income. Year 5. With reinvested dividends and assuming stable yield of 11.5%, Harry's investment in SPYI would grow significantly. After 5 years, his investment would be worth approximately $172,899. The annual dividend income at the end of the 5th year would be around $19,883, reflecting the increased value from reinvestment. Year 10. Continuing the reinvestment strategy over 10 years, Harry's initial $100,000 investment in SPYI would grow to approximately $298,536. By this time, the annual dividend would be around $34,832, significantly increasing his passive income. Year 20. Over 20 years, the compounding effect greatly amplifies the investment's value. Harry's investment in SPYI would grow to approximately $892,625. The annual dividend income at this point would be about $102,652, providing a substantial income stream. Year 30. After 30 years, assuming the same annual yield and reinvestment of dividends, Harry's reinvestment and investment itself in SPYI would be worth approximately $2,669,573. The annual dividend income would be about $307,001. This long-term growth projection highlights the substantial benefits of consistent investment and dividend reinvestment over an extended period. Navigating market turbulence with JEPI. The JPMorgan Equity Premium Income ETF aims to provide high income with a monthly income with reduced volatility, yet it remains susceptible to market risks. One major significant risk is its reliance on the options writing, which, while generating income, can limit upside potential during a strong bull market. For instance, during robust market rallies, JEPI's capped gains from options premiums can lead to underperformance relative to the broader market. Historical market conditions that have varied impacts on JEPI. During the March 2020 COVID-19 market crash, JEPI experienced a significant drawdown of approximately 30%, illustrating its vulnerability to sudden market shocks despite its defensive strategy. Conversely, in 2019's stable market environment, JEPI provided steady income with limited volatility. Sector concentration in large cap technology and healthcare stocks introduces another layer of risk. Should these sectors underperform, JEPI's overall performance could suffer. For example, in 2022, driven by rising inflation and interest rate hikes, JEPI faced increased volatility and a decline in value, although it continued to distribute its dividends reliably. While JPI's strategy of combining equity investments with options writing aims to, balance income and risk, investors should remain cognizant of these inherent risks. The potential for limited gains during market upswings and exposure to sector-specific downturns are critical factors to consider when evaluating the long-term stability and income potential of JEPI. Thriving in volatile markets with SPYI. The NEO's S&P 500 High Income ETF is designed to offer high monthly income, but it is not without risks. SPYI's performance is closely tied to the S&P 500 index, making it vulnerable during market downturns. For instance, during the 2008 financial crisis, the S&P 500 over 50% decline would have significantly impacted SPYI's value despite its income strategies. SPYI employs a call spread strategy involving SPX index options, futures contracts to generate additional income. While beneficial in a stable or moderately volatile markets, this approach can result in losses during extreme market volatility. The rapid market recovery in 2021 post-COVID-19 crash might have seen SPYI's strategy capping its potential gains, as option premiums could not fully offset the quick price appreciation of the underlying stocks. Market conditions greatly influenced SPYI's performance. In the bullish market of 2017, SPYI leveraged stable growth to provide substantial income. However, during the market volatile early months of 2022, driven by geopolitical tensions and inflation fears, SPYI experienced notable value fluctuations despite maintaining high monthly dividends. Sector concentration is another risk of SPYI. Significant investments in technology and consumer discretionary sectors mean any downturns in these areas can adversely affect the ETF's performance. For example, during the late 2020 tech sector correction, SPYI faced increased volatility and drawdowns, highlighting its sensitivity to sector movements. In summary, while SPYI strategies aim to mitigate risks through diversification and options trading, it remains exposed to broad market downturns and sector-specific risks. Investors need to consider these factors and the potential impacts of varying market conditions on their investments in SPYI. Ready to transform your investment strategy and boost your income? Dive into the world of JEPI and SPYI ETFs and see how they can reshape your financial future. With impressive yields and unique strategies, these ETFs offer compelling opportunities for both income and growth. Don't miss out on the chance to supercharge your portfolio. Hit that subscribe button, like the video, and leave a comment below with your thoughts on which ETF suits your goals best. Stay tuned for more insights on making your money work harder for you.